Good morning and welcome to our webinar, which we have named Chinese Equities, Falling Knife or Opportunity. My name is Stefan Newland. Together with my colleague Oliver Rothenberger, we are responsible for investor relations in Switzerland. Today, Stefan Kreushi and Wenjie Jie, partners of the HSZ Group, will review the performance this year, the current dynamics in the Chinese economy, some important topics like the state of the Chinese real estate market, and they will also share their outlook for 2024. Please ask your questions with the Q&A button. We will answer them at the end of the presentation. Now, Stefan, Wenjie, please go ahead.
A wonderful good morning, ladies and gentlemen, investors and friends. Thank you for joining our webinar today. My name is Wenjie and a partner at HSZ Group. I'm here today together with Stefan Kreushi, CEO and partner of HSZ Group and portfolio manager of the HSZ China Fund. The goal of our seminar today is to give our audience an update and outlook on China and Chinese equities. And we also want to answer the questions, are Chinese equities a falling knife or an opportunity? You can also send us questions at any time during the seminars by typing them in the chat box on your screen. We will answer your questions at the end of the seminars. Now, Stefan, do you want to say some words?
Yes, before we go into the webinar, let's quickly address the elephant in the room and talk for a minute about performance. 2023 has been a very difficult year for Chinese equities so far. After China rolled back its COVID measures about 1 year ago, we saw a strong stock market rally that lasted from November 2022 until January of this year. Unfortunately, the rally fizzled out in February when post-opening euphoria waned and the known issues like real estate market, geopolitics, inflation fears in the West, raising US interest rates, and fear of global economic slowdown took control of investors' sentiment again. The weakening of the CNY or the renminbi against the US dollar due to the growing interest rate differential was an additional negative. Year to date, the Chinese equity market, as expressed by the MSCI China, is down around 10%.
So, Stefan, there are many news headlines talking about the weakness of Chinese economy lately. And as a long-time China watcher, what is really happening and how do you see the macro?
We feel the underlying macro environment in China is slowly improving. About a year ago, China reversed its zero-COVID policy. We saw a subsequent pickup in the economic activities, followed by softening around the summer. In recent months, the economic growth and dynamic has picked up again. The GDP for Q3, for the third quarter, was 49%, or was 1.3% higher than for the second quarter. Growth year to date has been 5.2%, and in other words, we only need 4.4% growth in the fourth quarter to achieve the official target of around 5% for China. We believe China can continue to deliver a mid-single digit GDP growth also in 2024 and beyond. Wenjie, what are the bright spots based on your observations currently in China?
When we peel the onion by different GDP contributors, we see the consumers are doing well, with consumption growing at 5 to 6%. Service sector remains a bright spot this year, and there's no inflation. And in early October, the central government surprised the market with 1 trillion RMB or 137 billion US dollars stimulus plan. And we think the government remains responsive and putting more focus on the economic growth. Stefan, so the property sector is one of the major concerns for many investors. Can you walk us through your analysis on property developers' financials?
First of all, let me remind that we do not invest in property sector. In fact, we have not invested in the Chinese property sector since 2017. But you do, of course, monitor the sector as it accounts for around 25% of China's GDP. Based on our bottom-up research, the total debt of the property sector developers in China stands at around 12 trillion RMB, or about 1.6 trillion US dollar. The total debt peaked in 2021, and we have seen deleveraging by developers for the last 2 years. Out of the 1.6 trillion US dollar debt, 60% are bank loans and 40% are debt owed to the public who has already made down payments for apartments that have not yet been delivered. The loans are under restructuring lately, and the government is supplying capital to get the unfinished projects done. So in our opinion, the situation is under control. Wenjie, what should be the end game for the Chinese property sector? How should we think about this in the long term?
Sure. The Chinese property market is correcting, but we think it will find a new equilibrium level. So China is selling about 1 billion square meters of new homes, which is already down from the peak of 1.8 billion in 2020. So to put these numbers in context, there are about 20 million people entering the marriage age. So about 8 to 10 million new family, depending on your assumption of marriage rate. And let's assume each of them purchase 100 square meter flat. And this will translate to 800 million to 1 billion square meter new home sales. Obviously, for new home sales, there will be replacement demand as well. So while we don't know when the current market correction will turn, 800 million to 1 billion square meter new home sales could be the new equilibrium level. So Stefan, is there anything else you would like to add on the Chinese property sectors?
Sure, let me just add maybe one thing. I think it is important to remind investors that the current property market correction is the fourth one we have seen in the last decade. The first one was in 2011, the second in 2014, the third in 2020, and now. Compared to the past cycles, inventory is under control, particularly in the top tier cities. The high frequency data is already showing that the market is bottoming out. We think the worst for the property sector is behind us. Another question, Wenjie, we receive quite frequently from investors is, will China follow the path of Japan 30 years ago in the 1990s? What do you think?
We don't think this scenario is likely. China's asset price didn't run as much as Japan did in the 1990s. So at the peak, the land value to GDP was 559% in Japan, and this ratio is 239 in China. China has better forex management than Japan in the 90s. The renminbi index has been in tight range since 2016, and the underlying potential growth is much higher in China. The GDP per capita in China is still 1/6 of the US today, where Japan was actually 6% higher than the US in the 1990s. Moreover, there was an internal power struggle between the Bank of Japan and Ministry of Finance in Japan at the time. In China, the state actors are coordinated. So Stefan, many people talk about some foreign companies leaving China. And how do you see this impact China export?
Export as a percentage of China's GDP has steadily declined after hitting 36% in 2006. It is still 21% and one of the three important growth drivers for the country, along with consumption, which makes up 54%, and investment, which makes up around 43% of the GDP. Due to the US-China tension, China's market share of US imports has dropped from the peak of 22% in 2018 to 15%. On the other hand, China's market share in global exports has increased from 13 to 15%. China is increasing the export of more high value-added goods. This year, the combined value of China's car, solar, panel and battery exports combined will exceed the value of mobile phones and computers for the first time. Wenjie, this boils down to the questions that we hear quite often from investors, and the question is China investable? What is your thought here?
So we think China is investable. To the contrary, we believe China is a must for every diversified portfolio. Even with 5% growth per annum, China is still one of the fastest growing economies in the world. A floor has been put under the US-China relations. Moreover, there are many world-class and fast-growing companies in China. So in the last 5 years, approximately 1,500 listed companies in China have doubled profit. And this compares to about 1,000 in the US and in India. And today, foreigners only account about 5% of the Chinese mainland market's trading volume. And this means many of these fast-growing Chinese companies are still unknown to the global investors. Another observation is the Chinese bond market, which has been doing actually well. So in the last 3 years, the Chinese 10-year government bond was up about 8%, compared with the US 10-year government bond, which was down 23%. So this means investors are considering China as investable, in our opinion. Stefan, some critical people would argue that without Western technology, China will not be able to increase its productivity and return will diminish. What do you think about it?
Well, we have observed Chinese companies upgrading their technology quickly, especially in the last 2 years. China is the only country that has developed its own tech ecosystem beside the US globally. In August, we have seen an unexpected breakthrough in the high-tech area. Huawei announced its 5G smartphone. It was a surprise to the market and a shock to the US administration because Huawei was using locally made 7-nanometer chips in its new phones, meaning the US efforts to prevent China from accessing high-end chips have largely failed. Huawei targets 100 million smartphone shipment in 2024, more than double the 40 million it shipped in 2023. Obviously, it is true that compared to Apple's 3-nanometer chip, Huawei is lagging, but the gap is narrowing, and the ability to deliver 100 million 5G smartphones in 2024 shows that China can produce the high-end chip in scale. For what it is worth, before the US banned the chip export, Huawei was selling 120 to 150 million smartphones every year. Wenjie, this is a good segue, I would say, to our outlook for Chinese equities. What are your thoughts here?
Sure. China is undervalued in your opinion. The valuation multiple is at the low end of its historical range. And if we refer to Warren Buffett's indicator, which puts the stock market capitalization of a country in relation to its GDP, this ratio is 60% in China, and any level below 80 indicates an equity market is undervalued. In comparison, this ratio is currently 160% in the US and 150% in Japan. So any of these numbers above 100% indicates the market is overvalued. So it indicates the US and the Japanese market are overvalued. Moreover, the MSCI China is now trading at 10 times PE with a 12% ROE. Another interesting observation is the MSCI China index has never been down for more than 3 consecutive years. The current bear cycle for the Chinese equities actually started 3 years ago. So it's about time for the Chinese equity market to go up again. Stefan, what is your long-term outlook of China, and what are the companies you're looking for?
Starting from the valuation, the 24 companies in our HSZ China fund are currently trading at the weighted 18 times forward PE and an ROE, return of equity, of 14%. At the same time, we expect weighted EPS earnings growth of the companies in the HSZ China fund to grow around 60% in 2024. The margin of safety of the HSZ China fund, which measures the undervaluation of our fund, is around 100%. Given our selective approach to own only 20 to 25 stocks at any given time, the quality of the companies in our portfolio is much better than the market average. Moreover, we focus on entrepreneurial companies with a franchise that can generate superior returns over an extended period. At the same time, the long-term growth opportunities in China are intact. China is already the second largest economy in the world, but the GDP per capita, as we mentioned before, is still less than 1/6 of the US. In summary, for investors with a long-term perspective, recent weakness is a good moment to allocate or increase allocations to China. Moreover, 2024 will be the year of the dragon in the Chinese cycle. Dragon years are deemed to be very prosperous years in China. Wenjie, being here in Hong Kong allows us to follow current and emerging trends in China closely. Can you briefly talk about some recent trends in China?
We have observed the rise of Chinese domestic brands in the recent years across different industries. And for example, in the cosmetic industry, Chinese brands such as Proya, Botani, and Giant Biogenes, they're taking market share from the international players like Estee Lauder, Shiseido, and SK-II. In the sportswear industry, we see the same. So the Chinese brands like Anta, Li-Ning, they're eating the lunch of Adidas and Nike. This was in fact the trend we saw in Japan actually in the last 30 years. So many Japanese consumer brands became global brands, leveraging Japan's 120 million population. And bear in mind, there are only 15 countries in the world that have more than 100 million population. And China has 1.4 billion population that the Chinese companies can leverage on. Stefan, do you have anything to add?
Sure, let me just add one thing here. I think the consumer sector is one of the key areas we focused on. The Chinese consumer has a healthy balance sheet and excessive savings. Recently, we have observed the consumers shift to value for money. The HSZ China Fund benefits from this trend through positions in stocks like PDD. PDD or Pinduoduo operates the e-commerce platforms and targets to cut out the middleman. In the overseas markets, US and others, PDD is growing fast after launching its Temu platform in September 2022. Temu is also available in Switzerland, and I encourage you to try it if you haven't done so already. Wenjie, what are the other stocks that the HSZ China Fund is exposed to?
In terms of companies, the HSZ China Fund focuses on the Chinese branded consumer stocks. So this includes Midea, Proya, Nongfu Spring, and Anta. We also look at the internet platforms, PDD, Alibaba, Tencent, and Meituan, and some of the renewable energy stocks like Yangtze Power, Sungrow, Longi, CATL, and CLB.
We would like to conclude here by answering the questions you have asked at the beginning of the seminar, and the question is, are Chinese equities a falling knife or an opportunity? Our answer is clearly that we see more opportunity here. Of course, we cannot tell you exactly when we've hit the bottom, but we think we are very close to the bottom at this point.